This is the Asia Trade. I'm Shery in Bloomberg's Asia headquarters in Hong Kong.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. A positive lead-in for Asian stocks, with chipmakers driving the S&P 500 to an all-time high. But President Trump weighing in after the US closed, threatening tariffs of around 25% on cars, chips and pharmaceuticals as soon as April. Trump also says he may meet Vladimir Putin this month after the top US and Russian diplomats signal warming relations and steps towards ending the war in Ukraine. And Muddy Waters founder Carson Block tells us exclusively why he's staying on the sidelines of China's stock rally.
Take a look at how we're setting up U.S. futures right now, unchanged after reaching that record high on the overnight session. It's risk on. Investors most willing to take risk in 15 years, according to a Bank of America survey showing the cash levels have dropped to the lowest levels since 2010. The caveat, of course, these threats around tariffs on cars, semis, pharmas, reciprocal tariffs, still aluminum so much, and perhaps no relief coming from the Fed either. I mean, we have heard these signals coming about being in no rush to cut rates. The latest coming from San Francisco's Mary Daly. Take a listen.
At this point, policy needs to remain restrictive until, from my own vantage point, until I see that we are really continuing to make progress on inflation. At this point, policy's in a good place. We took 100 basis points off the rate last year. That recalibrated policy put it in line with the economy we have. And now we want to be, in my judgment, careful before we make the next adjustment.
We'll take a look at how we're setting up when it comes to this part of the world in the Asian Open. Quite a bit of trepidation, of course, with, again, these revived tariff risks. Here in Australia, we're just getting kind of the dust settling after the first rate cut from the RBA since 2020. We did see Australian stocks dropping in light of that as well, given that what was delivered was ultimately a pretty hawkish cut and signalling. The ASX 200 at the moment trading pretty flat at the moment. We did see financials and consumer stocks kind of weighing most when it comes to that downside and the cautious approach to future decisions about further easing for the RBA. Chicago Nikkei futures also looking pretty muted at this point. Dollar yen unchanged at 152 level. We are just seeing that sort of caution as the broader global trade war, the uncertainties geopolitically are continuing to play out there with those threatened tariffs across cars, semis, as well as pharmaceutical imports as well. We are expecting that announcement in early April, April 2nd. So these tariffs of around 25%, President Trump says we will probably see across those categories of goods, cars, chips, as well as pharma. And we're also expecting that announcement to be imminent in April. Our White House reporter, Skylar Woodhouse, joins us now for more in Washington. So what did we learn, sort of, I guess, with this announcement or this sort of set of comments that was different to previously? Skylar, I just wonder if you can hear us and can tell us a little bit about what we heard on these imminent tariff announcements.
Oh, hi, I got you. Sorry about that. So what we know from President Trump today, he said he was likely to impose 25% tariffs on the auto sector. Now, one thing to take into consideration with President Trump is, he hinted at coming as soon as April 2nd. But what we've seen so far with some of the other tariffs that he has announced, we've seen some delays, like with Mexico and Canada. So it's kind of sort of got to take these tariffs with a grain of salt on what President Trump is announcing today.
What's been the reaction so far? I mean, we've been hearing about these threats of more tariffs to come, especially for the auto sector.
Oh, yeah. I mean, I think across all sectors, whether you're, looking at autos, agriculture, health, pretty much every industry across the world right now is taking a look and figuring out, okay, how might my industry potentially be impacted by tariffs should they come from President Trump? So it's something, that we're seeing across the board here, different companies, industries, just sort of trying to get their affairs in order should they be hit with any sort of tariffs and what that could mean for their company's operations.
What are we hearing in the latest in terms of the possibility of granting Elon Musk access to US agencies?
Yeah, so what we're seeing right now, there's a lot of legal action flowing right now. Judges saying, that you can't receive access to things. But, so a lot of what is going on right now as it relates to Elon Musk and Doge, some of these things are being tied up in lawsuits. And it'll only be a matter of time before we start to really see what the courts, decide or what the trend across different courts start to look like. But it's just nonstop different lawsuits and legal action that's happening right now in Washington and across the country.
Bloomberg White House reporter Skylar Woodhouse there. And President Trump also says he will probably meet with Russia's Vladimir Putin by the end of the month. That's after the top US and Russian diplomats raised the possibility of broader cooperation following that meeting in Saudi Arabia with steps to ending the war in Ukraine. Marco Rubio and Sergei Lavrov promised to have high-level teams work on a truce that's acceptable to all sides. They also suggested bilateral sanctions could be eased and diplomatic channels be strengthened.
We're going to appoint our teams, respectively, to work very quickly to reestablish the functionality of our respective missions in Washington and in Moscow. For us to be able to continue to move down this road, we need to have diplomatic facilities that are operating and functioning normally.
Let's bring up Bloomberg News editor Michael Heath for more. So, really levelling up the cooperative kind of rhetoric here.
Yeah, I mean, it's almost like the past 3 years, the past decade almost hasn't happened here. It's got to be very, very concerning for Ukraine and for Europe in general. It looks like the US is more than happy to go over their heads and to sort of forge an agreement with Russia, and whether that means lifting sanctions, it certainly, as you heard there, means restaffing embassies. The US is, what it seems to be doing is it's giving away a lot of leverage even before they sort of get to the nuts and bolts of negotiations. So that it doesn't look good for Ukraine or Europe. Some of Bloomberg Intelligence has sort of done some work on this, and their assessment is that if, based on what we're seeing now, what we're likely to see is that those Russian-occupied territories sort of remain in limbo, that Ukraine will struggle to get the support it needs in terms of reconstruction, and just it'll be iffy about how strong its security agreements are. So, yeah, it's not a great sign. And the other thing, just to give a sense of the tenor of those talks, Sergei Lavrov, the foreign minister of Russia, there was a US proposal that Russia stop striking energy infrastructure, and he denied that Russia targets civilian infrastructure, which is an incredible claim, given that when the Treasury Secretary came last week to Kiev, Russia had just done exactly that. It's hit apartment blocks, all sorts. So the US seems to be taking very much an appeasing line here. The Russians were obviously extremely happy about it. They're looking to get the sanctions lifted. But of course, then you've got the other side is Europe. And so what the US is important for Russia in terms of the international financial infrastructure, but Europe is where Russia does its trade and where its elite has their homes and that sort of thing. And Europe, I think, is likely to take a harder line here.
We are also just getting comments from Scott Bessent at the moment, the US Treasury Secretary, speaking on Fox News. He calls President Trump's plan to end the war in Ukraine elegant. So, when you, obviously the removal sanctions is being dangled as a carrot at the moment. How likely is it that Europe is going to come to this party?
Well, you'd think unlikely, because, I mean, Europe has to live with Russia next door to it, and it needs, Ukraine is sort of the frontline state here, so it really, really needs Ukraine to be settled, to be sure of its security. And part of this whole reason that Ukraine needs security is if you're going to rebuild it, anyone who invests in it, or any country putting money into it, needs to know it's not pouring down the drain, that Russia won't be back there in a couple of years. So it's really, really important there. And the notion that the plan so far is elegant, it's an unusual description, because one of the points mentioned is that Ukraine is that there will be a ceasefire and that Ukraine will have to hold elections. And President Trump mentioned that as well. Ukraine's under martial law, and its presidential term has expired, but this is a real Russian talking point, because they're hoping that Zelensky will lose and they can find a more pliable leader. Russia talking about the need for elections and democracy is sort of ironic in its way as well. But yeah, look, it's all very fluid, but it looks like this is really falling Russia's way so far.
It must be really alarming for President Zelensky and also European allies. And it could even get worse if we actually do see President Trump meeting President Putin in person.
Yes, well, that's exactly right, Shery, because we can, you listen to Marco Rubio. He's a fairly standard Republican. He's pretty reasonable in his assessment of the global state of affairs. He's fairly mainstream, but President Trump with President Putin, there's obviously a lot of interest President Trump has in President Putin. That's been around for a long, long time. The relationship, as I've mentioned before, is extremely opaque. No one particularly understands what the appeal there is of Putin, who's been around for 25 years. Everyone's fairly clear on what he does and where he stands. But the President Trump, when they met in Helsinki during his first term, President Trump took the word of Vladimir Putin and the Russian FSB over his own security services in terms of Russian election interference in the US and these sorts of things. So really anything could happen in terms of giving away leverage or anything like that. Or it could be that President Trump's quite sensible and it's just, it's more of a meet and greet and pick fact. But you'd suspect that quite a lot will be done there, and Ukraine will be very, very nervous watching that. I mean, President Zelensky even cancelled his trip to Saudi Arabia, despite having good relations there, because it was just too uncomfortable, it seems, having the US and Russia meeting with Ukraine excluded like that.
Bloomberg News editor Michael Heath. That's bringing Garth Reynolds, who leads our Markets Live Asia coverage. And, Garth, we've seen the previous, hints of when more tariffs might come. The markets are quite good at shrugging that off because it's not immediate, right? So kick that can down the road. Is this starting to build a bit more pressure?
I don't really think so, because it's more of the same. It's another, 25% tariffs are coming at some stage on items that President Trump had already flagged. He said, we'll look at autos, we'll look at chips, we'll look at pharmaceuticals. The one thing that's perhaps concerning, perhaps it's not, is he specifically said we'll have discussions about these over the coming weeks, but we're looking to impose tariffs. I don't think there's been any reporting that there have been any actual discussions about this. Apart from President Trump claiming airily that there are companies, unspecified, who are looking to move factories to the US and who allegedly one of them is cancelling plans for a factory in Mexico or something like that. That's all very opaque. When, where, how exactly these tariffs come in, the answer, I suppose, is going to be April 2nd again, along with the reciprocal tariffs, all of which requires the Commerce Secretary to do a lot of fairly intensive reporting and recommendations and so on, at least if you're going to follow the letter of the law. So as markets are probably free to go, we've heard this before. Until we see the whites of the tariff size, we don't need to worry about it.
And analysts were saying also that given President Trump's transactional nature, that he might be more inclined to just struck a deal somewhere, anywhere, with anything at this point. But I wonder if markets are still being too complacent, because even if you take Trump out of the equation, you do have corporate America's profit outlook, for example, continuing to sour.
Yes, there is that, Shery, but there were some concerning signs in the latest Empire survey, which showed that small businesses in particular were pulling back on CapEx plans. The uncertainty gauge in there had jumped. It's not a great time if you're a business in America or a business who does business with America to be making decisions, because you don't know what's going to happen. To some extent, if you had actual concrete tariffs imposed right at this moment, okay, that would be bad, but you can adjust. Having them, or it's like, yes, they're definitely coming in on this date. Again, you can adjust. But now you're sort of wondering, well, do we try and get ahead of the game by importing a bunch of stuff before tariffs come in? But that might face logistical problems. There's a whole range of questions that really can't be answered, along with a range of other matters where Trump is busy dismantling parts of the government and facing all those legal challenges which were mentioned earlier. So there's a lot of uncertainty out there, which is impacting companies at the moment. Investors are they're almost taking a leaf out of the Fed's book, as it were. They're saying, well, we're not sure what the impacts of these policy decisions are going to be, political policy rather than monetary policy. So for now, we have to kind of take things as they are, and as they are, we don't see why equities shouldn't continue to climb. So let's buy equities.
Just keep going. We are seeing that caution play out for the Fed, again, when it comes to the inflation risk, and from the RBA as well with the hawkish cut. Not so for the RBNZ. They're going to go big again. It's sort of, and they're expected to signal even more dovishness.
Yeah, well, the RBNZ is in a very different situation because and this is very much the RBNZ's own tradition, they weren't fussed about the idea of we want to try and engineer a soft landing. They looked at what was going on with New Zealand and said, everything's overheated, we need to slam on the brakes, we're perfectly willing to engineer a hard landing, and a hard landing is what they got. When you get a hard landing, then yeah, you cut rapidly, and you keep cutting until you're sure you're starting to get actual traction in turning the economy around. There's nothing that signals that's the case for New Zealand, so they're going to keep going. Contrast that with the RBA, who copped plenty of criticism for not raising interest rates high enough, fast enough relative to a lot of others, and they specifically said we are pursuing a sort of soft landing trajectory. We want to bring inflation down without driving unemployment up. They've succeeded in doing that, hence the hawkish cut. The RBNZ is on a very different path.
Garfield Reynolds, who leads our Markets Live Asia coverage. And tomorrow on Bloomberg Television, do join us for a rare live interview with a senior official from Australia's central bank. We'll be asking the RBA Deputy Governor, Andrew Hauser, why policymakers remain cautious about easing after cutting rates this week for the first time in 4 years. That's coming up at 10:15 a.m. Hong Kong time. That's 1:15 in the afternoon if you're watching in Sydney.
And still ahead, Haidi, on today's Asia trade. China's January home prices are due in the coming hours. We'll look ahead with Jefferies. Capital.com telling us why they expect the U.S. dollar to keep declining. Plus, we'll be live at Consensus Hong Kong to talk crypto with the CEOs of Flow Traders and Bullish. Much more ahead. This is Bloomberg. The AI-fueled rally in Chinese equity markets this year has seen the likes of Goldman Sachs turning more positive on the mainland. But Muddy Waters founder and CEO Carson Block says investors should not be so quick to jump back in. He spoke exclusively at a special Bloomberg event in Singapore.
What I've been banging the drum about for 15 years is that the accounting of these companies, especially the ones that are public outside of China, the numbers cannot be trusted. And we are in a world where I think that matters less and less, a world that is dominated by passive flows, where active investing is receding or has been receding for quite some time. So maybe that matters less. But then you layer on top of that the geopolitical risk. It's funny, this morning we had a meeting with a potential investor, and the meeting was going really well, but at one point they told us that they were pretty invested in China, they were excited about it, and they look at things like that based on geopolitical or assessments of governments, et cetera, and government policy. And at the very end, I made such a mistake from a sales perspective because they asked, well, what do you think of China? And blah, 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 blah. I think Xi has been an absolute disaster for China. And literally the response was, well, okay, on that note, thanks for coming. So I think that, if you're willing to take the risk that you wake up one day and, China has gone to war to try to retake Taiwan or has barricaded the island, and that could lead to a kinetic war. If you're willing to take that risk, great. There's a price for everything. There's a price for that risk. I've been seeing Westerners like that for a couple decades, not really understanding what category of uninvestable China is in. They'll say the right things from time to time, lure the capital in. And I think that is part of the geopolitical strategy here, because China has always sought to co-opt opinion leaders and key financial people who are key economic and business leaders, always sought to co-opt them in the West, basically the Western elite. So the more that they can get everybody, levered to China, I think Xi is viewing this as a negotiating tactic should he ever make that move on Taiwan. So, I don't know. I think it's different.
But Xi has always talked about making that move on Taiwan, and he hasn't. And perhaps there is sense in that. And perhaps for investors, there's comfort to take from that. I mean, you talk about how it is uninvestable, but how do you view the rally we've seen so far? I mean, as a trader, as an investor, you're losing out on this rally.
Well, I don't know. I sleep a little better at night, I'd say.
You are hearing the right murmurings from Xi Jinping, I mean, on the back of the meeting he's had, for instance, with the tech leaders. Perhaps, he's realizing that he needs to do something differently.
Well, and it's not to say that this is unique to China, but, I lived there for a number of years, and I was actually lied to a decent bit. So and just because China hasn't actually made the move, I mean, that has more to do with military readiness. Taking an island from a military perspective is incredibly difficult.
Mighty Waters founder Carson Block there, speaking exclusively with Insight anchor Haslinda Amin in Singapore. More ahead on the Asia trade. This is Bloomberg. Still in the thick of earnings season, we had Santos full-year net income missing estimates. Paul Allen joins us now for more. So we were anticipating a softer result. Was there disappointment, or is it pretty much in line with expectations?
No, missed expectations, down 16% on the year. So we got a underlying profit there of $1.2 billion, and that was short of estimates, down 16%, as I say. Dividend was lower as well as a result, 10.3 cents. It gives us a total dividend for the full year of 23.3 cents. And Santos has been trying and succeeding in returning money to shareholders, $737 million returned over the past year, but still it's a disappointing result that's being reflected in the share price at the moment. But the outlook unchanged, 90 to 97 million barrels of oil equivalent for the 2025, cost unchanged as well to produce that, $7 to $7.50 per unit. Santos obviously at the mercy to a degree of the rather volatile oil prices that we've seen, but things that it can control are the cost overruns at some of its major projects. They're expected to improve as well. So we've got the Pikka project in Alaska, 16 of 26 wells now drilled. We're likely to see a startup of that next year. The Barossa project in the Timor Sea, that's now 91% complete. So a startup likely in July and September. And that's possibly why analysts still like this stock. We've got 12 buys, 2 holds, just 1 sell.
Bloomberg's Paul Allen there. We will be speaking a little bit later with the Santos CEO, Kevin Gallagher, for more on those earnings results. Their plans to target up to $150 million in annual structural savings. That's coming up on Bloomberg. Take a look at how we're tracking when it comes to the early part of the Asia trading session. Of course, Australia online for just about half an hour, just extending those losses that we saw across yesterday's post-RBA trading session. Consumer discretionary was sort of one of the biggest losers as we got that hawkish cut as anticipated from the Australian Central Bank. At the moment, we are seeing the ASX off by now over 1%, just really pairing some of those gains that we saw last week that drove it to fresh record highs. At the moment, we are seeing A bit of upside when it comes to utilities and materials, but financials off by 2.5%. We're seeing property and tech stocks also seeing some steep declines there as well. Singapore Nikkei futures also looking pretty muted. We do have, of course, a revived tariff threat being floated by President Trump, with an announcement now expected on April 2nd when it comes to 25% tariffs on cars, on semiconductors and on pharmaceuticals as well. In New Zealand, though, we are seeing sort of modest upside, expecting a big move today again from the RBNZ, and that's the picture when it comes to bonds as well as we head into that decision. At the moment, we are seeing Aussie bonds kind of looking like they could potentially be vulnerable to that short squeeze higher, but not a lot of movement at the moment. And New Zealand Central Bank is set to deliver its third big rate cut in a row, and signalling further reductions to come as well to try and rekindle economic growth during a time of recession. Our Bloomberg economy reporter Swati Pandey joins us now. So we're talking with Garth. You know, they're not doing anything by halves, both in terms of how they got into this situation and how they're going to get out of it. So another 50 basis points expected, and more dovish signalling to come as well.
That's right. It's the third 50 basis point cut. They were really aggressive on the way up as well. The forecast actually from here is of 25 basis points cut. So after today, the forecast is just 3 more cuts of 25 basis points. And this is from our Bloomberg survey of economists. We will get more insight from Governor Orr, and there will be a lot of document to digest today as well. There will be updated forecasts from them. So we will get a clearer idea of their thinking of where the economy is tracking and has tracked through this Southern Hemisphere summer period as well.
Swati, we do have risks on the horizon, right? Including, of course, as we continue to speak about tariff threats coming from the Trump administration. And, of course, it's pressuring the Kiwi dollar as well. How is the central bank going to factor all of those in?
I'm pretty sure that trade and this whole global uncertainty is going to play heavily in their discussion. This was something that Reserve Bank of Australia's Governor Michelle Bullock yesterday mentioned as well during her press conference, that this uncertainty has played on their mind. And we are seeing that, like you said, in the currency reaction too. And that is one of the reasons that inflation progress could actually be stalled, and that could be one of the reasons the RBA may signal this lower interest rate, the speed at which they are cutting, basically. So not going at 50 basis points again and signaling 25 bips, or maybe even a higher terminal rate than what markets are predicting right now.
Bloomberg economy reporter Swati Pandey there as we await that RBNZ rate decision today. And of course, we're watching China as well. The property crisis there worsening with a record $160 billion pile of distressed debt and a brief revival in home sales fizzling out despite government stimulus. Home prices seeing the worst slump on record. The latest data due in about 2 hours. Let's discuss with Shujin Chen, head of China Financial and Property Research and China Economist at Jefferies. Shujin, really good to see you here in the Hong Kong studio. So first of all, what are we expecting today, I guess?
Sure, yeah. So first, regarding to the property price, we still expect a kind of like a decline, but moderately decline month on month. So in the past few months, we've already seen that home price, for the secondary market home price, the decline every month seems to be quite small. And this month probably could be continue the trend in January, yeah.
What happened to that brief revival that I mentioned when it came to home sales? I mean, we saw this effort from the government to support the property sector with more stimulus measures. Why has that fizzled out?
So on one hand is that we do see some impact on the property price already. For example, in some tier 1 cities, their property price largely stabilized in the past 3 months, thanks for the further loosening on the home purchase. So that actually helped quite a lot. And for example, like some tier 1 and major tier 1 cities and a few tier 2 cities, we also expected that they will see kind of like a price stabilization this year, thanks to this kind of like supportive policy. But on the other hand, is that especially in the second half last year, people realized that the problem is not only on the property market, but it's for the whole economy. Like the lower expectation from the higher income class people, that's the key issue now.
What does that mean for all of these companies that are already suffering, whether it's Vanke, for example, that was supposed to be a little bit too big to fail and the support coming there, but even other defaulters who seem to be showing a little bit signs of recovery, like Sunak, for example, now saying that they can't necessarily rule out a second restructuring?
So on one hand is that I think it's very hard to say like a developer is too big to fail. If we look at like more the statement published by the China financial regulator, normally they will see some like, for example, systemic important companies, but mainly financial industries, right, like large banks. But for property developer, we have already seen like a few ones defaulted in the past 3 years, and it seems has not too much. There's not too much impact to the systemic to the financial system in the past 3 years. So I think it's still hard to define Vanke as like too big to fail. And the second is that we have seen that there's quite a lot of supportive policies to support like Vanke from the Guangdong province and Shenzhen city government. But on the other hand is that because they are hard to be defined as too big to fail, so that we haven't seen too much support from the central government level. And at this stage, we see that there's quite a lot of like management change in Vanke, and therefore it will take like months for them to assess like how much money they need to needed for potential payout. And I think at this moment it's still too early to say a payout. Yeah.
Shujin, how closely correlated remains the relationship between household sentiment, consumer sentiment, and the property sector? Can that side improve without meaningful structural support for property prices?
So on one hand is that we do see that consumer sentiment and property purchase are now more related to the expectation of income, especially for higher income population. When we define a higher income class, we would say that if your monthly salary is if the monthly disposable income is more than 6,000 RMB, then you would be among the top 20% in China. So these people are the major buyers for the properties, and also they have a key contribution to the consumer. And in the past 2 years, we have seen quite a lot of supportive policy, but more focus on the mass market. And these higher income population still see a relatively, their income expectation can hardly change in the short future. So without the change in the income expectation, we actually see that, there's still something that government can do, as we have already seen that, like the whitelist and ensuring the delivery of the house, and also more supportive policies for the financing for the developers. So this can help a bit on the market, but overall we still need to look for a turnaround for both the income expectation and also the consumer sentiment when we are talking about property price bottoming.
How are banks' balance sheets doing in light of all this? Because we know that there's, some pretty opaque calculations in the way that Chinese financials handle non-performing loans. Is that sort of a systemic risk that's continuing to build?
Very good question. Yes, there are quite a lot of investors doubt about China's NPL ratio, especially regarding to the property development sector. But on the other hand, is that if we look at the past round, during the 2012 to 2015, China went through a down cycle, economic down cycle, due to the overcapacity issue and SME default. But we see that banks actually dispose and recognize more NPL during 2016 to 2019 when the economy recovers and after the down cycle. proposal. So on one hand is that the recognition of NPL, because it will follow the overdue ratio, and these seems to be largely lagged the cycle. On the other hand is that I think the China banks trying to deal more with the NPL recognition and disposal when during the economy recovers. So this time I also expected the same action. So when we see a turnaround, and we may see there are more NPL recognition at that time, probably.
You mentioned earlier, for example, how the central government was not that active in getting involved, for example, with Vanco. Do you expect more support to come from Beijing given the threats coming from the Trump administration and how big the property sector is for the Chinese economy overall?
Gotcha. So on one hand is that we have seen the property sector contribution to the overall economy largely declined in the past 3 years, right? It peaked in 2021, and both the property developer loans, the overall scale shrink quite a lot, and also for the contribution for the GDP. Now the estimate is from previously around 30% related to the GDP, now only around 10% or 10 to 15%. So the contribution has declined quite a. The overall impact from the property sector decline has largely reduced. But on the other hand, is we do see that there's a potential for China government to conduct more stimulus, focus on the domestic demand. If the Trump's Trump's administration's tariff rate, became more than market expected. For example, currently we see that global investors' expectation for the potential tariff next year, in the next 1 year, is to increase to 40% to 60% for China. So in April, we'll see the potential. We'll see more details from the Trump administration. So it can be higher than that number. There's a possibility for China to further conduct trading policies for the consumption upgrade, and also more supportive policies for the salaries or pensions for people.
Shujin Chen, really good to have you with us here in the Hong Kong studio, head of China Financial and Property Research at Jefferies, of course, as we look ahead to that property sector data coming from Beijing later today. But if you missed any part of this conversation, TV Go is your function. You can also dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg. Breaking news out of the U.S. Senate right now. We are hearing that Howard Lutnick has been confirmed by the Senate as Commerce Secretary in the Trump administration. Of course, he's the billionaire CEO of Cantor Fitzgerald. We're expecting this confirmation to take place. He's expected to oversee a large department with responsibilities ranging from fisheries management to export controls. But of course, most importantly, he has been tasked by the president with leading the administration's tariff and trade agenda. Again, Howard Lutnick now confirmed by the Senate as U.S. Commerce Secretary. Right, Japan will aim to cut greenhouse gas emissions 60% by 2035 under a revised climate target. The new goal is seen as falling short of action required to meet Paris Agreement goals. Let's get more from BNEF head of APAC Research, Ali Izadi. Ali, what do you make of these targets?
So at face value, as you mentioned, the targets would be insufficient for well below 2 degrees Celsius target of the Paris Agreement, particularly the 1.5 degrees Celsius target. At the same time, it's still relatively good for Japan to at least be ahead of some of its G20 members and submit its updated NDC, laying out its target for 2035 and 2040. Japan is only the 5th member of the G20 to submit its updated NDC, even though the original deadline for all UNFCCC members was to submit their updated NDCs by February 10th. It is short. A bigger issue, of course, is that even if you look at Japan's existing 2030 target, which was 46% emission reduction by 2030 relative to 2013 levels, the country is not on track to meeting the current target. So it only had achieved emission reductions of about 19% for the latest year that the government had provided data at the end of 2022. It's only 19% for the period of 2013 to 2022, whereas the target for 2030 is 46%. So they're currently not on track to meet even their 2030 target. They would have to scale up the pace of emission reduction by about twice the current rate to hit that. If they hit that, then maybe they can have an opportunity to hit their own modest target, and then whether their target will contribute to the overall global target of meeting the Paris Agreement goal will then heavily depend on whether their peers also show similar ambition.
What are the critical steps, Ali, that Japan needs to take to actually realize that target?
So for all countries, the most important lever is increasing clean electricity supply and accelerating electrification in final energy. If you look at Japan's seventh strategic energy plan, which has been being drafted in parallel to coming up with the updated NDC, the government is still foreseeing that by 2040, the country would continue to heavily rely on fossil fuel thermal power generation. That makes it really difficult if Japan proceeds with such an approach to actually achieve its own relatively modest emission reduction target. The government is also still relying heavily on bringing back nuclear power. We've seen nuclear power plant restarts fall far short of government's existing plans. For renewables, it has upped the target, but in the case of renewables, it's prioritizing sort of unproven costly technologies such as perovskite solar, rather than really looking at scaling up mature, proven renewable technologies.
Bloomberg NEF head of APAC research, Ali Izadi there. Well, the remote Pacific Ocean nation of Nauru aims to sell citizenships for the climate-threatened island to help meet the cost of moving 10,000 residents from low-lying homes. It highlights the immense challenges that small nations are facing in financing ways to adapt to climate change. Our climate and ESG managing editor David Stringer has more on this story. And David, we've sort of long documented the struggle of these small island nations. Are passport sales enough in terms of being able to finance their needs?
Morning. Well, you know, I guess this whole issue, and really it ties back to the points Ali has just been making. As we see less ambition, as we see developed nations, not achieve as much as they need to in terms of reducing emissions, it's putting more emphasis on climate adaptation. What can those countries, often low-lying island nations, those are in the front line of climate change, what can they do to boost their resilience? For Nauru, we know they have this ambition, a decades-long project to move the majority, about 90% of the population, from low-lying coastal areas that face really severe issues with flooding and move them to higher ground, And the fact is there simply isn't enough financing to do that available right now. So what we're seeing is these kind of innovative, novel solutions. In the case of Nauru, also in the case of Dominica as well, that involves selling citizenships. It's one tool they found to raise some revenue, but is it enough? Absolutely not, nowhere near enough. The strategy that Nauru has is likely to take many, many hundreds of billions of dollars, and look, what they're expecting to achieve initially is to raise about $65 million from initial passport sales.
Yeah, so tell us a little bit about that funding gap between rich nations and poorer nations and the challenges that these smaller countries face.
It's really something that's coming to a head, and as I said, you're sort of really going to come into more sharper relief as we see countries row back from some of the more ambition in their targets. If we think back to Azerbaijan, we had the COP29 climate talks at the end of last year. The whole thing was a huge row about climate financing. Smaller nations, developing nations were looking for about $1 trillion a year or more from rich countries. What we got in the end was a deal in which wealthy economies pledged about $300 billion a year, way less than what's needed. And in fact, the UN estimates that the gap between available financing and what's required could be as much as about $359 billion a year right now.
Bloomberg ESG and climate managing editor David Stringer. You can get more on this story on the terminal and later on Bloomberg.com. But we do want to take you to breaking news out of Japan right now. We are getting the latest trade numbers, and exports rising 7.2% year-on-year for the month of January, beating expectations. We're also seeing imports gaining more than 16% year-on-year, and this leaves a trade deficit that's coming in at 2.8 trillion yen. Of course, we have been watching perhaps businesses loading up on orders ahead of these tariff threats coming from the Trump administration, and also the reaction when it comes to a weaker yen. Core machine orders also a contraction of 1.2% month on month, which is a contraction instead of a growth that was expected for the month of December. We have more ahead on the Asia trade. This is Bloomberg. And these are some of the stocks that we'll be watching when trade opens in Korea and Japan. Nissan's in focus after its credit default swaps widened to the most among Japanese companies that have overtaken both Rakuten and SoftBank after its consolidation talks with Honda were terminated. Also watch LG Energy Solution shares after Toyota agreed to shift a $1.5 billion battery order to one of LG's Michigan plants after GM pulled out of an earlier deal. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is the Asia trade. We're counting down to Asia's major market opens after another record high on Wall Street. But of course, the caveat for investors across Asia, Haidi, is that 25%, around 25% tariff that could come on cars, semiconductors, pharmaceuticals as well. President Trump saying that announcement to come as soon as April 2nd.
Yeah, again, the revival of these tariff threats, or the imminence of these tariffs, but also the geopolitical developments, right, when it comes to really a revised strategy between the US and Russia, and even potentially talking about dropping these sanctions as well. So pretty massive shifts that we're expecting on the geostrategic front as well.
Yeah, and we have seen that risk-on mood given the geopolitical tensions easing perhaps in Ukraine, starting to really be felt throughout the markets. Global stocks rallying. You can see the Nikkei right now coming online with the Japanese yen holding steady at that 151 level against the US dollar. A little bit of downside early in the session, but of course we had a 10-year yield already topping those highs that we saw in 2010. Of course, expectations of that BOJ rate hike to come at a time when we've already seen exports continuing to gain ground. We are talking about gains of 7.2% year on year for the latest data. A little bit to the downside miss on the estimates, but still China's exports to China contracting, but that also to do with the impact from the Lunar New Year holidays. Take a look at how the Korean market is coming online, because we've been watching, of course, LG Energy Solutions. We're hearing that Toyota is veering $1 billion of orders to one of its Michigan plants, but at the same time, autos are so important for this market. We know that Hyundai Kia's sales in the U.S., more than 60% of that coming from imports. So we'll be watching the reaction as the Kospi gains 0.3%. And we're seeing a little bit of weakness for the Korean won, Haidi.
Shery, take a look at what we're watching in Australia. Of course, we are looking at the day after kind of impact when it comes to the RBA's first rate cut since 2020. And we did see stocks falling and just extending that fall again into the midweek session as well. We're seeing a little bit of upside when it comes to materials and utilities, but real estate in particular, one of the biggest laggards in the session, as well as tech stocks as well. The Aussie dollar is trading kind of sideways, 63.50. The underperformance that we're noting is really in the Kiwi dollar. They're really the worst performer among G10 peers, as we expect another big cut to the official cash rate from the RBNZ today. But after today's 50 basis point move, the projections are looking to show smaller steps of 25 points to fall towards 3%. But still, another big move expected for the RBNZ there. And we're also seeing Kiwi stocks seeing some modest gains. Also watching oil, which is steadying after advancing on the possible postponement of OPEC plus supply increases. A lot of uncertainty around flows from Russia, particularly with this talk of these warming sort of dynamics between the US and Russia as well, and whether those sanctions on Russia could be dropped as a carrot for ending the war in Ukraine. Let's bring in, for some analysis, Kyle Rodda, who's a senior market analyst at capital.com. And Kyle, as Shery mentioned, we get that sort of revival of the tariff talk, and we could know more by the start of April, certainly. But at the moment, it feels like markets, at least in the US, are willing to just keep kicking that can down the road and keep on buying.
Yeah, it certainly does seem to be that way. And I mean, the tariffs are certainly the most pressing source of uncertainty at the moment for the markets, and probably, potentially the biggest downside risk in the short term, really on the basis that we don't have a great deal of clarity as to how these tariffs will take place. And of course, they're very much tied to sort of the temperament of President Trump and how he wishes to sort of potentially go at his adversaries. I mean, I think one thing that the markets have been, I suppose, boosted by is that there has been this more measured approach, that there seems to be this kind of approach given to the Secretary of Commerce to look at trading partners on a case-by-case basis, which leaves the door open for negotiations with each individual trading partner, at least in principle, to perhaps seek concessions and lower tariffs when they come, effectively suggesting that the worst of the tariffs won't materialise. But there is the argument that more than just a negotiating tool and wanting to sort of just extract concessions and sort of fairly zero-sum victories, that this is a Trump administration really wanting to shake up the global trade order and restructure the US economy. And in that instance, the markets aren't pricing that in and could be a really significant risk if it comes to pass. So at the moment, again, the kind of measured approach and the fairly conciliatory by the Trump administration's standards approach to its trading partners is boosting market sentiment that it can sort of progressively price in these tariffs. But there are significant downside risks and uncertainties, as we're seeing this morning with this comment about 25% tariffs on autos, for example.
And that sort of takes us to our MLive blog question of the day, which is talking about this TINA trade. There is no alternative other than the US, and how long that plays out for, because it's, to be fair, we have seen US equities underperforming globally so far this year. We've seen global recession expectations dropping to a 3-year low as well. But at the same time, US-driven geopolitical and trade uncertainty rising. So do you expect this to change when it comes to the optimism that we continue to see for the US?
Well, I mean, it will depend on sort of trade and foreign policy in the United States, how more or less the rest of the world trades. And I mean, if you do look at a lot of European indices, and even, for slightly different reasons, Chinese markets and broader Asian markets recently, they've traded quite strongly. In fact, arguably, we're seeing a little bit of a rotation on the basis that, we're seeing very rich valuations in the United States, especially driven by those Mag 7 names. And, arguably, perhaps a risk and reward in US equities that isn't very attractive. So at the margins, and, perhaps the currency channel has also helped this in Europe and the UK, for example, with the FTSE, that there has been this kind of rotation back into very value-centric sectors of the market. It just really does come down to the US's trade and foreign policy, because if they take a fairly multilateral approach with foreign policy, maybe are able to achieve some victories and easing tensions in the Middle East and of course Eastern Europe, then that's going to be a sort of a tailwind for the rest of the world as well when it comes to economic activity. And if the tariffs aren't applied as aggressively as feared, that's actually going to be fairly solid for global growth. And the markets can go back to thinking about, the sort of more bullish elements of the Trump administration's policy platform, which is deregulation and fiscal spending, which, while beneficial for the United States, will also be beneficial for the rest of the world and global growth and global economic activity. So it really does depend on the Trump administration's foreign policy and trade policy stance. And at the moment, if that continues to evolve the way that it is, it's a big if, that could continue to see this sort of strength in European and Asian assets.
What's happening with gold? We continue to get these positive comments around the price of gold. Goldman Sachs now saying that they're seeing a target of $3,100 an ounce by year end. Does it still have room to run at this point? I mean, it's been an incredible year.
Yeah, I mean, and the tailwinds just seem to keep building up for gold on the basis that, if you look at what's sort of underlying this, I think you could loosely say this is a bit of a de-dollarization trade, or more particularly, we are seeing a real rush in the physical, excuse me, a real rush in the physical markets from central banks more or less trying to diversify their reserves away from treasuries and into gold, and that's, a kind of trade away from, getting exposure to the US. The other element too is that we're seeing apparently a bit of a squeeze in physical markets as a lot of traders try and push gold towards the United States preemptively to avoid tariffs. And then if you look at the headwinds recently when it comes to the gold price, it has been a stronger dollar and the prospect of fewer rate cuts in the United States. Marginally, that's becoming a little bit of a tailwind as well. You overlay that with concerns about Trump's profligate fiscal policies and concerns across the globe about, the sustainability of foreign debt. Gold just looks like this really, really strong play that, even the kind of headwinds look more likely to become tailwinds in the short term rather than, these major tailwinds becoming headwinds. So it seems to me that the trend remains to the upside. And again, this kind of squeeze in physical markets at the moment just suggests that, maybe we can push towards 3,000, in the space of weeks, if certainly not in the coming months.
Can the dollar tailwind continue?
It's a trade in foreign policy story once again, and effectively one of the reasons why we have seen the dollar pull back over the last few weeks is these hopes that there's going to be this measured approach from the United States when it comes to tariffs, and then also these sort of building hopes that maybe even if it's a little bit unlikely at the moment, especially considering the Ukrainians aren't at the table at the moment and are going to be reluctant to maybe commit to not joining NATO and giving up territory, that if we see some kind of peace deal struck or stability seen in Eastern Europe, that's going to be very, very good for the euro. That's going to be fairly negative for the US dollar. I suspect, and I thought this coming into the start of the year, that dollar positioning was a little bit stretched, that we'd see a fairly similar situation to what we saw in the first Trump administration, which after the election we saw the dollar rip, really as we priced in that Trump trade. But then over the subsequent 12 months, that kind of positioning eased and we saw the dollar drop. And there was also that kind of focus back on that kind of Trump fiscal agenda, which sort of lifted the proverbial tide, all boats throughout the global economy, boosted economic activity, and we saw the dollar continue to fall. The big variable at the moment is how tariffs and Trump's policy contributes to inflationary expectations and interest rate expectations going forward, because that's the big difference between this term and the last term. But if we see stable inflation and rates that, even if they remain around 4%, which looks like it will be roughly neutral in the United States, or at least for the United States, then I think that the US dollar will continue to fall from here, notwithstanding at the moment, just over the next few days and weeks, what looks like a little bit of a bounce on the cards. But I suspect the US dollar will continue to move lower here, but the big turning point, if it were to occur, would be because of maybe US trade and foreign policy becoming more hawkish and less good for the global economy.
Kyle, always great to chat with you. Kyle Rodda, Senior Market Analyst at Capital.com. Let's take a look at a couple of the stocks that we're watching in terms of what's moving so far into this session. Trading's been underway for just over an hour here. National Australia Bank is seeing quite steep downside. Shares really tumbling. Although off the session lows, we were down by close to 9% at one point after first quarter earnings declined due to stronger competition, rising credit impairments there as well, with that unaudited net profit of 1.7 billion Aussie by the end of December 31st. The 3 months there, the stock is continuing to see downside, and the margin decline suggests that NAB is really hitting on the brakes when it comes to business lending, given that we've seen increased competition amongst the big lenders when it comes to home loans. And this, of course, as we've seen that a first cut from the RBA in 4 years as well. We're also watching Santos there. The full year net income missed estimates despite even a pretty soft set of expectations. They were still disappointing. We also had that stock cut to hold at Morgans Financial Limited with a price target of $7.20. uncertainty there. So that is also seeing some downside of just over 2%. And we will be getting more analysis when it comes to those Santos numbers, the guidance and expectations going forward. The CEO, Kevin Gallagher, and the Stockland CEO as well, Taryn Gupta, will be joining us for more on their outlooks following the release of earnings.
And Heidi, take a look at some of the after-hour stocks that we were watching, because Intel just had the biggest rally since 2020. There's speculation, of course, of a breakup. We're also watching a super microcomputer jumping on a bullish outlook. Walgreens soaring. Media reporting that Sycamore Partners take private deal with private equity firm Sycamore Partners is still actually possible. And also remember that incredible rally of Meta Platforms. It was the longest winning streak of any current NASDAQ 100 index component going back to 1990. 20 days of gains has finally been halted. Of course, we had that AI-fueled rally. And we've just heard that Analog Devices board is now authorizing the company to buy back an additional $10 billion of shares, bringing the total remaining authorization to about $11.5 billion. We're awaiting those earnings results as well in a few hours. Still ahead on Bloomberg, we'll be live at the Consensus Conference in Hong Kong, bringing you interviews with global leaders in tech and finance who are gathering to discuss deal-making opportunities in crypto. More ahead on the Asia Trade. This is Bloomberg.
President Trump also says, in addition to his commentary about tariffs, that he'll probably meet with Russia's Vladimir Putin by the end of the month. That's after the top US and Russian diplomats raised the possibility of broader cooperation following that meeting in Saudi Arabia on steps to ending the war in Ukraine. Marco Rubio and Sergei Lavrov promised to have high-level teamwork on a truce that's acceptable to all sides. They also suggested bilateral sanctions could be eased and diplomatic channels be strengthened.
We're going to appoint our teams respectively that have worked very quickly to reestablish the functionality of our respective missions in Washington and in Moscow. For us to be able to continue to move down this road, we need to have diplomatic facilities that are operating and functioning normally.
That's Bloomberg News editor Michael Heath. A resolution that's acceptable to all sides. You've got to wonder how Ukraine's feeling at the moment.
Yeah, I mean, one of our stories has a very interesting final quote from former Secretary of State Blinken, who said that if you're not at the table in these international events, you're probably on the menu. And unfortunately, for Ukraine, that's sort of how it feels a little bit now. I mean, this notion of outside of President Trump meeting with President Putin, which we've seen, during President Trump's first term, can lead to sort of quite unusual scenes as well. The fact that Europe and Ukraine have been excluded from this, that the US is talking about sanctions relief, that they're restaffing the embassies, and on one hand, what Secretary of State Rubio said was right there. You need to have staffing in order to hold these negotiations, but also it's a point of leverage that the US has that it doesn't really want to be giving up, and sanctions in particular. I mean, the US has been able to, whatever failings the sanctions have had, Russia has been in many ways excluded from the global financial system. It's become a lot more difficult for its people to move money around, or its elite basically. So these are handy things for the US to have in its pocket when it negotiates, and if it's going to put them on the table, it really puts itself on the back foot. And even the scene where you have Russia's Foreign Minister Sergei Lavrov, I mean, they're talking with Rubio. I mean, Lavrov came out and spoke about a US proposal that Russia stop targeting Ukrainian energy infrastructure, and he just blatantly said that Russia doesn't target civilian objects. Now, that's just not true. We've seen a campaign to basically deprive Ukraine of its energy systems coming into the cold of the Eastern European winter, and there's been apartment blocks, all sorts of things. So just elevating Russia onto this status that it's basically normal and that we can sort of put this war behind us, it's going to be very, very difficult for Europe to stomach, and Ukraine, let alone Ukraine. And yeah, there's just a lot of questions thrown up there for both of those groups.
Well, Treasury Secretary Scott Bessent, who we heard from an earlier interview, saying that President Trump's plan pulls the U.S. and Ukrainian interests together, and that he actually thinks President Zelensky will sign an agreement. Again, how alarming is this? Not only for Ukraine, but also for Europe, as you mentioned, that this has really security implications for the whole continent.
That's exactly right, Shery. I mean, this is what we're talking about. This will have implications for years, potentially. And if a deal is done over the top of Ukraine and Europe in particular, I mean, it's them who have to, it's these countries and this bloc that have to live with the repercussions of that, particularly if it falls in Moscow's favour, because Russia will just be emboldened. I mean, President Trump has this sort of fascination with Vladimir Putin, but Vladimir Putin's been there 25 years. His modus operandi has been clear for a long, long time. And he basically respects strength and force, and he doesn't respond to personal relations. I mean, he's smart enough to be cordial and all these sort of things, but when push comes to shove, he's a hard politics man, and he'll take every single favour that the US is offering, and he's unlikely to offer much, particularly if the US is going to act like these horrors that have happened just haven't happened. And part of the plan they're talking about, I mean, Secretary of the Treasury, he may well be right. It may be that Zelensky has no option, but even this idea of the US getting 50% straight off of the licenses for Ukraine's critical minerals, I mean, that does nothing for Ukraine. It needs investment, it needs security guarantees. I mean, there's nothing in it for them. And the other side of the deal that they're talking about is that there'll be a ceasefire and there'll be elections in Ukraine. This is a standard Russian talking point. So, it's really looking like it's falling in Moscow's favour here.
Bloomberg News editor Michael Heath here. More ahead on the Asia trade. This is Bloomberg.
We're seeing a little bit of a rebound in crypto assets after Bitcoin lost ground for 3 consecutive sessions. In fact, down more than 10% after it hit a record high on the day of President Trump's inauguration. A little bit of disappointment from the lack of really aggressive crypto policies, including, of course, a Bitcoin strategic reserve. Well, the annual Consensus crypto event begins today, bringing together players in blockchain, digital assets, and Web3. It's being held in Hong Kong for the first time as the city moves to establish itself as a digital assets hub. Let's cross over to Annabelle Jewelers, who's standing by with our first guest. Belle.
Thanks, Shery. Yeah, it's actually the first time as well that Consensus is back in Asia. But I want to bring in Flow Traders CEO Mike Kuehnel this morning joining us. And Mike, you're here for the conference, you're here for a couple of days, but what is the main message that you're going to be sharing with investors that you meet and different market participants?
Yeah, thank you so much for having me. I think one of the key elements we want to get right over the next few days is to talk about scalability and driving innovation into scalability. So there is a tremendous amount of appetite to talk about multiple use cases that are now coming into the digital asset space and the DeFi space. I feel it's quite important to just stand still for a moment and to talk across the community. How are these use cases connected? What are the benefits related to these use cases? And how much do we need to further lean in on driving innovation into the same direction? And I feel it's a tremendous opportunity to be here and to connect with peers across that theme.
Flow Traders is a business, so you're just coming off your earnings. I think it's the second best fiscally that you've had, or fiscal year on record, also the best fourth quarter numbers ever. But there is that sort of question around how you maintain consistency in the numbers as well. So what's your strategy around that?
I think one of the key elements of our strategy is that we're embracing TradFi and digital assets DeFi at the same point in time. It's fair to say 5 years ago I would have told you DeFi is taking over and the TradFi world will disappear. And now we have many indicators leaning into a growing belief that there is coexistence. And coexistence also has significant benefits we can lean in as a liquidity provider and market maker. one key element is what we call cross-chain liquidity. So making sure that institutional investors, but also retail investors, are able to move their assets, move their liquidity from TradFi to DeFi, and very much with a risk-adjusted mindset, trying to find yield, but making that a reliable and institutionalized experience. That's quite critical. So where we stand now as a company, I feel we bring the capability to the table in order to make that a reality over the next few years.
And so you need trading capital, of course, to do that. And to that end, you've suspended the dividend since the midpoint of last year. Do you see that also staying in place for quite a while to come?
I was quite clear and transparent to our investor base and said as long as we are able to generate highly attractive trading capital returns, as long as that prevails, we will keep the capital in order to outperform on growth. And as indicated with 2024, our trading capital return, even with an increased level of capital, stood at 69%. So that's quite impressive, I feel. And with the optionality around the company and leaning into further ETP adoption and digital asset adoption, I'm quite excited about the prospects for the company for the years ahead.
And not just about crypto, of course, you've mentioned more traditional financial products as well, but you do come to Asia relatively regularly. You've met with a lot of the Chinese stock exchanges, Hong Kong as well. What do you see in terms of the potential of the ETF market here, or ETP as well?
So one element that really excites me is that there is a growing understanding that ETP adoption is driving prosperity across financial markets. And I also talked about democratization of financial instruments a lot. So the ETP product is the possibility to really bring retail investors into the game and also drive product innovation. So I'll give you a very specific example. If you're seeking more international underlyings, the ETP wrapper is a very cost-efficient way of getting exposure. And I feel we are able to deliver the technological capabilities in order to make that a reality. And across APAC, I feel it's also an opportunity to address the fragmentation we have there.
Just very quickly, you've announced that you've got a stablecoin, All Unity.
Yeah.
When is that going to be coming out? It's with DWS and also Galaxy.
Yeah, the stablecoin project, or Unity, will come to market end of Q2, beginning of Q3. I am not shy in saying I'm very excited about it, very much leaning into accelerating institutional and retail adoption on the digital assets front. So the way I talked about coexistence between TradFi and digital assets, we feel that the stablecoin is providing a significant utility in order to make that a reality.
All right, Mike, thanks very much for joining us this morning. That was Mike Kuehnel there, Flow Traders CEO. As we kick off Consensus here in Hong Kong, one of the world's biggest crypto events, but back in Asia for the first time in 6 years.
Thank you so much.
We are, of course, counting down to another major central bank decision. The RBNZ set to set policy in the next hour. Very much expecting another big cut there, another cut to 50 basis points from the RBNZ. This would be the third of that magnitude as it continues to try and really reverse the course of the economy, given that it is in such a deep recession. The projections are going forward is that this will be the last 50 basis point move, and we'll continue to see 25 basis points, so smaller increments going forward. We are seeing that underperformance when it comes to the Kiwi dollar. In fact, the worst performer in that G10 space. We're also seeing a bit of downside when it comes to equities trading here in Australia as we continue to sort of pass through what was a very hawkish cut from the RBA, I should say, despite, of course, the first easing move in 4 years. Expectations are for perhaps 2 or 3 more this year, and it will be a very shallow cycle of easing. We're seeing, in fact, property stocks, some of the consumer stocks not doing terribly well today. Some upside for utilities and mining. At the moment, we are seeing some outperformance when it comes to trading on the Kospi. That's up by 1.3%. And watching New Zealand equities, we did have sort of a bit of upside earlier, but that is now reverse course as we're just treading water ahead of that RBNZ decision. Well, Singapore's Prime Minister has unveiled an expansionary budget, including plenty of handouts ahead of national elections this year. Despite that, Lawrence Wong is also forecasting a budget surplus. Bloomberg's Avril Hong joins us now from Singapore. And Avril, you know, we've seen thematically this across many elections, right? Cost of living crisis, the impact of inflation, really where these battle lines are being drawn. What are we seeing from the government?
Yeah, absolutely. I think the cost of living crisis really a key feature, including in Singapore, and that's playing out in terms of what we heard from the government in its budget just a day ago. It was a long list of handouts, rebates, infrastructure investments, so ways to bring down the cost for households, for businesses, and increased spending. It was interesting. Despite this, the government is expecting for a second year a budget surplus of about $5.1 billion, and that amounts to roughly 0.9% of GDP versus analyst estimates of a deficit of 0.3%. And I think it was really interesting as well. This is a budget that was seen as a something for everyone kind of budget in a year where a national election needs to be called by November. I think one MP actually remarked that he'd sat through so many budgets over the years, and this was one where he really saw a lot of the suggestions, the views being taken in. It wasn't just that there are planned cash handouts. Even the world-renowned hawker centres, the hawker stalls in Singapore, are expected to get some rental support. So I guess the question then becomes, is this going to be enough momentum for the ruling party to ride on into the elections? Is this going to be enough to boost voter sentiment? Or is this an electorate, a different generation? Maybe they have different priorities. It's worth noting that this budget was the first delivered by Prime Minister Lawrence Wong, and I guess it was a way for him to showcase his brand, his style. And I think it's fair to say that it was a pretty consultative approach that's being taken here by the Prime Minister.
At least for now, are we expecting that boost to come from the stock market, especially in those sectors when we talk about handouts, perhaps consumer sectors, also infrastructure spending?
Yeah, I think it was an expansionary budget overall. So some of the obvious beneficiaries, so to speak, would be the Singapore lenders, the banks. They're expected to benefit from a pickup in business activity, the improvement to asset quality. But it's also worth noting, if you dig a little bit deeper and you look at the infrastructure investment plans of the government, it kind of tells you what the growth roadmap over the longer term is going to look like. And I think there's a graphic that we can show you here. It kind of outlines, AI technology. That's top of the list. There's going to be $1 billion chip R&D facility. Financial support is expected for businesses to capitalize on AI. And overall, Singapore's taking quite a light touch approach when it comes to AI regulation. So it's against that backdrop that Bloomberg Intelligence thinks Singtel, the country's largest mobile carrier, is best positioned to benefit. It can draw on its partnerships with hyperscalers, with 5G networks. Worth also noting that when it comes to investments, major investments also being planned for clean energy. To secure clean energy, there's going to be a study for the deployment of nuclear energy as well. So green energy sectors could also benefit.
Avril Hong there joining us from Singapore. We'll also be watching HSBC today, reporting fourth quarter earnings with attention focused on the financial aspects of the bank's worldwide restructuring program. For more, let's bring in our China correspondent, Min Lo. Min, of course, it's been a difficult year and we have seen these restructuring efforts. So what are we expecting today?
Yeah, I guess this is the first public opportunity for the CEO, Elder Harry, to give us a sense of that restructuring plan, the scale of it and the cost of it, because just last week we were reporting that HSBC is again starting a fresh round of job cuts this week in its investment banking division, starting here in Asia and then eventually affecting global employees, and that could be staggered over several weeks and months. And this comes after he had taken the company through pretty big overhauls, pulling out of certain businesses like the advisory underwriting businesses in Europe and US. He also combined certain divisions to reduce duplication, to enhance efficiencies. He also cut his own group of executive committee members by about a third. So we'll be looking out for what he has to say, more clarity around those plans, and also whether the company will once again announce any share buyback, because they have been quite consistent in announcing that the last few quarters. And you take a look at the consensus forecast here, net revenue expected to be at $15.8 billion. That is a 2% decline from the previous year. Net income, though, expected to come in at 5.24. That is a 33% increase from the previous year. But bear in mind, this time last year, HSBC had to write down a huge amount of impairment charges because of their China exposure, the investment into BOCOM at the time. So all of this factoring into the earnings report as well.
Right. Mimi Lo here with the latest on HSBC and what to expect. You can get more analysis on that. TLIV Go is your function to get commentary and analysis from Bloomberg's expert editors on HSBC as it reports its fourth quarter earnings. We actually have a very busy earnings season right now. UOB has announced a $2.2 billion package to distribute surplus capital over the next 3 years. Southeast Asia's third largest bank will introduce a new share buyback program and plans a special dividend. UOB's fourth quarter earnings met estimates, helped by growth in lending, even as non-interest related income remained flat. Baidu reported a smaller than expected revenue drop from the last quarter, helped by gains in its artificial intelligence business. The generative AI boom resulted in a 26% quarterly jump in cloud revenue, more than double the pace of growth during the September quarter. But that rise was overshadowed by signs of weakness in its core search business. Shares of Howard Hughes Holdings fell sharply in extended trading after Bill Ackman's Pershing Square submitted a revised proposal to buy the real estate firm. As part of the offer, Pershing Square would acquire 10 million newly issued Howard Hughes shares for $90 apiece. Ackman was chairman of Howard Hughes for over a decade. Elon Musk's artificial intelligence startup xAI has debuted its updated Grok 3 model. The company says Grok 3 beat OpenAI, Alphabet, and DeepSeek's models across math, science, and coding benchmarks in claims yet to be independently verified. xAI also introduced a new smart search engine, calling it Deep Search. We have more ahead. This is Bloomberg.
Let's get you back to the Consensus Crypto event in Hong Kong, where Annabelle is standing by with our next guest. Belle.
You have any good...
Thanks, Heidi. Yeah, I've got the Bullish CEO Tom Farley joining me here this morning. And Tom, we were just saying it's been a pretty big few hours for you because you're just hot off Bullish finally getting its crypto license here in Hong Kong. There's also different news events that we can talk about as well. But let's start with the license first for Hong Kong. How are you planning to use it exactly?
It's great to be back. I'm a little jet lagged. Woke up this morning reminded how great my colleagues are. It was the news was we have the new license that we've been working on for a couple of years with the SFC. We sold out our conference here in Hong Kong. This is the first year, and we're completely out of tickets. And we broke a huge story on our news side, CoinDesk, about Malay and this stable coin, and this meme coin. So yeah, quite a morning. I have the best colleagues in crypto. The license is very exciting. Long time coming. We went to the regulator when the SFC came out with a formal license program, and we said we want to be a part of it because we're a compliant business. We hold ourselves out to be, adult operators and really institutional focused and befitting of a place like Hong Kong. And so we've been working with the regulator, and our goal is to bring global liquidity here. So we have a model where we'll do all the onboarding of Hong Kong businesses, citizens here in Hong Kong, the custody here in Hong Kong, but giving them access to global liquidity, which I think is sorely needed. And I think that's part of what the regulator's been working on pretty smartly.
Is it kind of coming at almost, I don't want to say too little too late, but the direction is definitely shifting back, or has already shifted back to the US with Trump now in the White House. What does the regulatory roadmap look like for you there?
No, it's definitely not too little too late. There's plenty of firms here in Hong Kong. There's also, I want to say 15,000 ultra high net worth folks here in Hong Kong. All sorts of people who are interested in trading crypto and want access to a local market with global size liquidity. So no, it's not too late. And I don't think of Hong Kong as competing with the United States really. I mean, crypto is a truly global market, and I think you're going to see regional competition because the way regulators are attacking it is they're regulating what they can within their borders and then doing their best to provide their citizens the ability to access, say, a global central limit order book or global pot of liquidity, and that's exactly what we're doing.
But here we do have some regulatory clarity. We still don't really have it in the US just yet.
Right. So regulatory clarity is really, it's coming in all over the world in waves. So Hong Kong effectively started this year, you could argue a little bit last year. Same with Europe. There's a regulation in Europe that really kicked in January 1, so a month ago. Smart regulation, really just consumer protections, more transparency, and then the U.S. will follow. I think it'll follow within the next 2 quarters. I think most people would say at some point in 2025, but I think it's coming. I think out of the U.S. you'll likely see a stablecoin bill passed this year by both chambers of Congress and a bill on the rest of crypto. And I'm hoping what comes out of that is just some basics, like what's a security and what is not, what can you issue, what can you not, what do you have to disclose, what is the transparency you have to provide. And on the stablecoin front, I think it's the basic questions of how much do you have to hold in reserve and how do you hold it in reserves. Just really the elemental building blocks for digital assets that really the prior administration just wholly neglected in the U.S. So a lot of optimism.
So are you making any sort of specific business plans then around what you expect to be announced this year?
Yeah, we haven't formulated them nor announced anything, and I'm not going to break news here, but we operate 2 businesses, Annabelle, as you know. We have a global exchange called Bullish, and then we own I'll call it the leading crypto-focused media business, CoinDesk. We could debate that, but CoinDesk owns Consensus, which is the conference we're at here today. Many of our consumers on the CoinDesk side are Americans, really roughly half. And so there is kind of a natural pull for us to do more in the U.S. We've never brought on a customer on our Bullish exchange in the U.S. Even though we could do that, we've chosen not to because the environment has been so hostile. So many lawsuits, so much hostility. Now all that's changing. We have a customer base in the U.S. Obviously, we're kind of whiteboarding what might be an opportunity for us.
In terms of opportunities as well, there's a number of different companies, and we've reported as another crypto, a news organization that covers crypto, Bloomberg, of course, we did have the scoop on Bullish looking ahead to an IPO. What's your expectations around that?
Well, if we were looking ahead to an IPO, I have to be very careful with my words. As the former president CEO of the New York Stock Exchange, I know to be circumspect around my language with respect to this topic. If we were, I'll note a couple things. The IPO window is still by and large closed. You're not seeing really any IPOs in the U.S. or Europe, and that's kind of the nature of the beast. You have to ride the waves of the markets and the whims of the markets. We've always run our business as if it were a public company or to be ready for the public company. And we have things like auditors, that's a big deal in crypto, but Deloitte and Touche and the right banking relationships and the right compliance posture. So at some point I could see that in our future, but I can't say too much more.
Okay, so you can see a listing at some point in the future. Do you see that listing venue being in the U.S.?
So, boy, I don't know. I feel like over here, I went to a lunch yesterday. There were 22 people, and I was the only American there. So I don't know. Maybe we Americans, we think everything revolves around like New York City or Washington, D.C. So that would be a natural inclination for me if I were doing the decision making. But as much as anything, there aren't a lot of IPOs in Hong Kong or Europe either. So right now, if you look at the capital markets, I'd say the U.S. is probably the deepest and most liquid market for fintech IPOs.
Okay, and in terms of the timing, do you see it being this year, for instance? Because again,
wow, you're really driving me on this topic.
Well, we're interested.
So
this year, I mean, there's a number that are looking, for instance, June, July.
Honestly, I still think of Bullish as just like a tiny, plucky company trying to meet customers' needs. Truly, I do. And we have so much we want to accomplish. We just got this license in Hong Kong. We want to build our Hong Kong business. We want to build we just got a license in Germany, the full German sort of, blessing to be a crypto business in Germany. We hope to extend that to all of Europe. So we're focused on that. We have a launch of new derivatives products coming out in 2 months. This conference, we've been quite apprehensive about it. We just invented this conference out of thin air. It's not an easy undertaking. So all of those things, if we solve all of those things, I think the world will open up to us. And it starts with that, starts with happy customers, and then we'll think about all those strategic alternatives.
All right. A tiny, plucky company.
Scrappy. Scrappy.
They were your words. That was the Bullish CEO there, Tom Farley. Haidi.
Annabelle Jewellers there in Hong Kong. And we do have more conversations from Consensus coming up. We'll be hearing from Wintermute's CEO after Tencent announced its investment in the crypto market maker. Robinhood's crypto VP will be with us as well, and the Binance CEO Richard Tong discussing the fallout from the jailing of their billionaire founder, Changpeng Zhao. Well, the AI-fueled rally in Chinese equity markets this year has seen the likes of Goldman Sachs turning more positive on the mainland. Muddy Waters founder and CEO Carson Block says investors should not be so quick to jump back in. He spoke exclusively at a special Bloomberg event in Singapore.
What I've been banging the drum about for 15 years is that the accounting of these companies, especially the ones that are public outside of China, the numbers cannot be trusted. And we are in a world where I think that matters less and less, a world that is dominated by passive flows, where active investing is receding or has been receding for quite some time. So maybe that matters less. But then you layer on top of that the geopolitical risk. It's funny, this morning we had a meeting with a potential investor, and the meeting was going really well. But at one point they told us that they were pretty invested in China. They were excited about it, and they look at things like that based on geopolitical or assessments of governments, et cetera, and government policy. And at the very end, I made such a mistake from a sales perspective because they asked, well, what do you think of China? And blah 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 blah. I think Xi has been an absolute disaster for China. And literally the response was, well, okay, on that note, thanks for coming. So I think that, if you're willing to take the risk that you wake up one day and, China has gone to war to try to retake Taiwan or has barricaded the island, and that could lead to a kinetic war. If you're willing to take that risk, great. There's a price for everything. There's a price for that risk. I've been seeing Westerners like that for a couple decades, not really understanding what category of uninvestable China is in. They'll say the right things from time to time, lure the capital in, and I think that is part of the geopolitical strategy here, because China has always sought to co-opt opinion leaders and key financial people who are key economic and business leaders, always sought to co-opt them in the West, basically the Western elite. So the more that they can get everybody, levered to China, I think Xi is viewing this as a negotiating tactic should he ever make that move on Taiwan. So, I don't know. I think it's different.
But Xi has always talked about making that move on Taiwan, and he hasn't. And perhaps there is sense in that. And perhaps for investors, there's comfort to take from that. You talk about how it is uninvestable, but how do you view the rally we've seen so far? As a trader, as an investor, you're losing out on this rally.
Well, I don't know. I sleep a little better at night, I'd say.
You are hearing the right murmurings from Xi Jinping, on the back of the meeting he's had, for instance, with the tech leaders. Perhaps, he's realizing that he needs to do something differently.
Well, and it's not to say that this is unique to China, but, I lived there for a number of years, and I was actually lied to a decent bit. So and just because China hasn't actually made the move, that has more to do with military readiness. Taking an island from a military perspective is incredibly difficult.
Muddy Waters founder Carson Block speaking exclusively with the Inside anchor Hasinda Amin in Singapore. If you missed any part of that conversation, TV Go is your function. You can also dive into any of the securities or Bloomberg functions that we talk about. Also become part of the conversation. Do send us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg.
We are, of course, counting down to another major central bank decision today, and it is the RBNZ turn to be in the spotlight. And Shery, this 50 basis point move, this is a third straight one, is looking like a pretty much a done deal, right? Particularly as we saw them move so, steeply when it comes to in the other direction, and now we have this pretty severe recessionary conditions there, and they really want to kind of go big and go hard. But the focus, I think, is going to be on the projections for the OCR going forward, because there's expectation that they will kind of slow the pace a little bit and do 25 basis points going forward until they get to that 3% level.
And the implication really for the markets as well, right? I mean, Garfield Reynolds, our colleague at MLive, pointing to the fact that we could potentially see some more pressure on Kiwi bonds, such as what we saw with Australian bonds. We saw yields really gaining ground after that hawkish rate decision by the RBA, cutting for the first time in 4 years. But of course, really the governor of the central bank in Australia signaling that there could be a change to the outlook, given, of course, President Trump's tariffs and the threats that are coming and the risks from, of course, different policies on trade, Haidi.
Yeah, with every central bank decision, including this one from the RBNZ, we'll be watching for any commentary remarks about those global trade uncertainties. You can get more on your Bloomberg on this. Tell LV Go is where you get that live blog and live analysis from our team of expert editors. This is Bloomberg.